Think you've got Dallas real estate all figured out? Well, think again. From garbage can loans to a 2008 repeat, we need to talk about what's really going on in the Dallas housing market. Well, hello, I'm Wendy Pinnell, and I can't believe I'm saying this, but garbage can loans are back. I mean, everyone said we wouldn't have a market meltdown like we did in 2008. You know, we have a completely different housing market. But the fact is, there are actually a lot of similarities to 2008 in the current housing market. I mean, for example, just like 2008, risky mortgages are back. One of these loan types are 1% down loans. CNN Business reports that Zillow Home Loans is rolling out a new option, a 1% down payment. Through the program, an eligible buyer pays as little as 1% toward a down payment. Zillow Home Loans pays an additional 2%, bringing the total down payment to 3%. Now let's think that through, okay? If Zillow is willing to chip in 2%, do you think that buyer is actually paying market value? Or is it far more likely that Zillow has propped up the value by at least 2%, so the buyer is overpaying? I mean, yeah, let's just inflate that price a little bit and make it look like we're chipping in order to get the loan closed. Another risky loan type people are using more and more of are adjustable rate mortgages. Now, these loans have been around in the housing market, but what's so alarming is how many people are flocking to them now. And what's even worse is when they turn to them, it is so often based on the assurances that rates are going to come down. Okay, we don't know that. According to the Mortgage Bankers Association, when mortgage rates hit historic lows in 2021, ARM loans accounted for less than 2% of mortgage applications. When rates went up in 2022, the share of ARM loan applications peaked at nearly 13%. Now that's a major increase in 1 year. Then, as recently as last week, Joel Can reported that the level of ARM applications increased by 15% over the week. As you might imagine, adjustable rate mortgages are skyrocketing right now. But here's what I want to know, okay? Do these buyers really understand how these loans work? Or are they being told, don't worry about it, don't sweat the details, mortgage rates are going to come down? So much of the risk here is in how prepared these buyers are, and do they understand the loan program? And have you ever thought about this? How can a loan officer truly qualify a buyer when they don't know how high the mortgage will eventually adjust to? I mean, yes, the loan will have an adjustment period cap as well as a lifetime cap, but is the buyer really prepared for how high the payment could go? I mean, imagine if you bought an adjustable rate mortgage with a 6% rate and it's time for it to start adjusting. It could easily adjust to 8% in today's market. A $500,000 mortgage would go from $29.98 to $36.69. I mean, your payment just went up $671 a month. Another big concern I have right now is how lenders are qualifying their borrowers. I am really not liking what I'm seeing at all. I mean, basically, the loan officers are being sloppy with the escrow account and how they're qualifying their borrowers. I mean, let's just say a new construction home is valued at its land value of $40,000. The property taxes might be $50 a month. The very next year, the home will be reassessed and the value will go from $40,000 to $500,000. I mean, there is probably a difference of $500 a month just in property taxes. And guess what? The lenders are qualifying their borrowers based on the $50 a month. All right, now we're talking within 1 year. All of these borrowers' payments are going to go up by $500 a month. Think that's going to put some of them in default? Yeah, it absolutely will. Your average homeowner cannot handle their mortgage payment going up by $500 a month. Loan officers should be qualifying their buyers based on what their taxes will become, not what they are at land value. I mean, I almost want to use the word fraud here because buyers in this situation are genuinely not qualified for the homes they're buying. Another huge similarity I'm seeing is that the whole mortgage industry is in big trouble, just like it was in 2008. During the 2008 housing crash, we saw hundreds of mortgage companies go bankrupt and thousands of employees being laid off. Well, fast forward to 2023, and we're seeing it happen all over again. If you check out the website, thetruthaboutmortgage.com, they have an article titled A Long List of Mortgage Layoffs, Mergers, and Closures. They describe how they first created the list in 2007 of mortgage layoffs and closings and have continued adding to it over the years. The writer Colin Robertson explains since early 2022, mortgage layoffs have been driven by a major decrease in refinance demand and a dwindling pool of eligible home buyers thanks to significantly higher mortgage rates. Then if you scroll down on his site, you will literally see thousands of layoffs, bankruptcies, and mergers. Okay, we are talking thousands. Think about this. When we hear about how jobs are still really strong and unemployment is low, you need to remember loan officers are self-employed. They aren't eligible for unemployment. The bankruptcies, the lenders going broke, okay, that isn't going to register with unemployment statistics because they don't qualify for unemployment. Now, whether we like it or not, there are way more similarities to 2008 than anyone is talking about. Oh, and how about how the Fed has tried to fix the housing market both times? Each of these times, the Fed's goal in raising rates has been ineffective. In 2008, the Fed raised rates and it didn't slow down the market because of alternative forms of financing like option arms. There were so many negative amortizing loans and adjustment rate loans that it didn't matter how much the Fed raised rates. It wouldn't work. Well, today in 2023, we're looking at how the Fed has been raising rates both in 2022 and 2023, and it is again not having the effect they'd like to see. And why isn't it working? Well, new construction is providing all these incentives and alternative forms of financing to give buyers a way out of the high interest rates. And this is also sending mixed signals to the Fed. All right, I mean, let's go ahead. Let's talk about shelter costs, okay? Shelter costs are the expenses that include rent, mortgage, principal and interest, okay, that sort of thing. Well, these are a huge part of CPI, also what we call consumer price index, okay? So huge that the Fed has to keep the interest rates up because shelter costs aren't dropping. As long as shelter costs continue not to drop, the Fed will think its work isn't done, and then rates, they're going to continue to increase. So once again, we see these similarities between now and 2008. Another big issue we need to talk about is how student loan payments will affect the housing market. People begin resuming their student loan payments in October, and this is definitely going to make a difference to many buyers and homeowners' budgets. In fact, CBS News recently published an article about the effects of student loan payments resuming. It shares how about 44 million Americans with student debt must start repaying their student loans, a change that could impose a financial strain on many households after a 3.5-year hiatus. 44 million, that's not a small number. All right, but how much of that is in Dallas? Well, according to the Federal Reserve Bank of Dallas, student loan debt has been on a serious upward cycle since the early 2000s, more than tripling in 2018. Dallas is now looking at well over $100 billion worth of student loan debt. Having to resume payments on this much debt is going to cause some serious tightening in the economy. People are going to have a lot less money to spend. Some even think it will tip us into a recession. Thomas Simons chimed in on the subject. He says the consumer was running out of gas already, and they weren't going to be able to maintain their current pace of consumption. He continues, this is an additional straw on the camel's back, and it might be the one that puts us into a recession. CNBC shared that with debt payments erased, consumers would have had more wiggle room in their budgets and would have pumped more money into the economy. So that's an interesting twist, all right, because we've actually been trying to slow down the economy. But on the other hand, potential buyers need more wiggle room because housing is so unaffordable. So most Americans already don't have enough income to match the growing home prices, and now we're throwing an extra expense at them through student loans. But here's a silver lining. CNBC shares how overturning student loan forgiveness is deflationary and means the Federal Reserve may not have to raise borrowing costs as much as it otherwise would if forgiveness succeeded. Seems like the lack of people's ability to spend may indirectly be a good thing, at least for a little while. Shay Akaba said this will work in the direction of further slowing consumer spending, and that will directionally contribute toward the Fed's goal of getting inflation back to its target level. Okay, long story short, whether or not the silver lining in all this is worth it, this will prevent people from buying a home. Robert Farrington states that according to research from the Federal Reserve Bank of New York, the average student loan monthly payment is $393. And the National Association of Realtors reports that 51% of non-homeowners with student loan debt said that debt is delaying them from buying a home. So how is this going to make its way through the market? I mean, will we see mortgage delinquencies increase? Are we going to see this big wave of foreclosures? Well, I think it may increase delinquencies for some, but probably not for most homeowners. What it's more likely to do is add greater debt to most people's student loans. When given the choice between the two, people will probably make their house payment and not their student loan payments. So on the front end, I think we're definitely going to have less buyers able to enter the market. On the back end, I'm not so sure we'll see this big increase in foreclosures from it. Another thing we really need to talk about is this. A housing market can have record low inventory and still not be the riotous seller's market that so many realtors claim it to be. Right now, sales volume is at an all-time low of 4 million. In 2021, it was well over 7 million. We literally have almost half as many sellers as we did 2 years ago. We just don't have sellers entering the market. They're not interested in trading their 3% mortgages for an 8% one. Well, most realtors are going to point to that lack of available inventory and say we're firmly in a seller's market. They're going to use the phrase month supply whenever they say this. Well, here's the thing. You don't want to treat this market like a seller's market regardless of month supply, because unlike a real seller's market, buyer demand is also down. So what this does is it distorts the true definition of a seller's market. So yeah, we have low month supply, but that's not the only thing that makes up a seller's market. So what exactly does make up a seller's market? Well, I love how knock.com determines it. Okay, they use 6 different metrics and month supply is only one of them. This is what their article says. Okay, number 1, average sales to ask price ratio. In the Dallas area right now, it's 95%, which is down 0.6%. Number 2, number of homes sold. In Dallas, that number is 8,701, which is down 15%. And this is where we see that volume is so far down. In a true seller's market, you would have more buyers than sellers, and you would see more sales. All right, number 3, inventory. The number of active listings is 30,655, which is down 0.9%. Number 4, median days on market. Okay, it's 45, which is up 40%. In a true seller's market, we would not see median days on market up 40%. At number 5, median sales price is $370,000, which is down 1.3%. Number 6, month supply is 3.3 months, which is up 10%. Do you see how using all 6 metrics presents so much more of a balanced view? Okay, so why does this matter? Why do you need to know all of this? Because there are certain approaches you take in a seller's market, okay? Such as offering above list price or offering to pay for things a seller could pay for. If you believe it's a seller's market, you may think you need to do those things. Suffice it to say, if sellers don't actually have the advantage, don't give it to them. The downside to all of this, of course, is that we haven't seen a sustained home price correction. We don't have prices raging ahead like we do in a seller's market, but we haven't seen sustained price drops like we might in a buyer's market. Okay, now I have another topic you seriously need to be aware of, especially if you watch many housing crash videos. All right, this is what you need to know. Dallas is not representative of the nation as a whole, and it's not even representative of Texas as a whole. I recently watched a video where the YouTuber said there was no such thing as seasonality. I mean, he quoted all kinds of facts and figures, but he never once quoted data from Dallas. Now here's the thing, real estate is extremely micro-local. This means real estate factors can be drastically different in 2 areas that aren't even that far from each other. In fact, American Legend Homes in Frisco, they thumbed their noses at us when we mentioned negotiating. Normandy Homes in Prosper did the same thing. Meanwhile, Meritage Homes in Fort Worth is offering a ton of incentives, as is Antares Homes in Midlothian. Here's my point. If real estate is that different just within the Dallas area, you need to know Dallas is hugely different from the rest of Texas and of course from the rest of the country. So anytime you're listening to a video about real estate, pay close attention to whether they're quoting Dallas or national statistics. This is true for statewide statistics as well. Like some cities in Texas are experiencing severe downturns, such as Austin. Newsweek published an article recently saying the housing market in the city of Austin, Texas has become the focus of widespread concerns after home prices have dropped faster than anywhere else in the country. Several other Texas cities are predicted to have severe downturns. Go Banking Rates listed 40 cities at the highest risk for a housing crisis in the nation. 8 of those 40 were in Texas. Meanwhile, Dallas is over here chugging along as among the top 4 hottest markets in the nation. The article Housing Market 2023, these 4 cities have the biggest housing shortages, states how hot markets are those with low housing stock and population inflow, including San Antonio, Dallas, Houston, Orlando, and Las Vegas. Now, don't miss that phrase, population inflow. Okay, Dallas's market is dependent on people relocating here. And that's part of why it typically sees such seasonal shifts in prices. When families are relocating across the country, they're generally gonna do that in the summer when they have time to get their kids enrolled in new schools. If population inflow ever stops in Dallas, the housing market would be in serious trouble. Vance Cariaga states how 4 U.S. cities had the most constrained housing supply during the second quarter. 3 of them are in Texas, San Antonio, Dallas, and Houston. So in Dallas, we have population inflow, which brings us demand, but it is strongly seasonal. Right now, we're in the fall and winter season, and we're enjoying those seasonal drops, though so far they haven't been quite as severe as they were last year. Last year, we were seeing widespread, massive drops by this point. This year, they're more in line with what we would see like historically. For example, Denton County is up 0.1%. Collin County is down 2%. Dallas County, after having a huge drop last year, is up 5% compared to this time last year. Rockwall County, down 5.4%. Tarrant County is down 4.1%. Ellis County is up 0.4%. That being said, with real estate being as micro-local as it is, we're seeing some beautiful price drops throughout the Dallas area. It's just not as widespread and uniform as it was last year. In fact, I did an entire video about our biggest price crashes that we're seeing right now in Dallas. You can watch that video right here. In the meantime, Wendy out.